So in this video, I want to go over an example of our financial process documents that we've put together. There's about 8 or 10 different categories, inventory management being one of them. So I'll walk through this one as an example and talk a bit about how it's organized and how you can use this to implement these best practices in your business. So we really start by thinking about what are all the different components of inventory management. So we've broken it down into these 6 categories. There may be others, and we can, add or update as necessary. But these are the things that affect inventory. So it's the receiving process, the shipping process, the truck return to warehouse, inventory counts and keg tracking. Those are all quantity-based things that occur. And then a cost review, which is obviously the cost of the dollar side of the inventory. So I'll go through each of these quickly, kind of give you an overview of how the document lays out. And again, the idea here is to kind of give you an SOP that you can download and use right away. You're going to need to update this, obviously, based on what's best for your business and what your specific practices may be, but I think this will give you a good overview. And the benefits of SOPs, again, instructions on how to do things in a certain way to get a predictable result. And so important that they're written down. And what I find is very often they're not. It's one person trains another. It's word of mouth. Maybe we've got this written down, but not that. So the idea here is to try to get as comprehensive as we can without overdoing it. So that's kind of what we're shooting for. So we start really with inventory management. We want to define a goal. Here again, I'm not sure this is often defined or communicated, but what is the goal for inventory management? Here's an example. It's to really safeguard, control, and have a complete, accurate record of inventory. I think everybody can get behind that. But if we go through each of those words, like what does that really mean? Safeguard. Well, we want to keep it safe. We make sure we don't have unnecessary breakage. We don't inadvertently lose or misplace things, or we're disorganized. Safeguard. We want to protect it. Do we have alarm systems? Do we have video cameras, things of that nature? Control and have a complete, accurate record of inventory. That's going to require really the whole process, and this is a system that works together. So I'll go through each of those: receiving and shipping and so forth. Next, we want to say, all right, we've defined the top level goal and why it's important, and now we want to put some measurements around that. So how do we actually quantify good inventory management? And we've got a whole inventory management dashboard, so key ratios. These are just a handful of examples. So efficiency measurements are days of inventory, so days on hand or inventory turnover, how efficiently we're measuring or managing our inventory. We want to look at out of stocks. We want to look at inventory count accuracy. So each of these things we can specifically measure, see how we're doing, set a goal to improve, and define what good inventory management looks like in terms of numbers. Next is a recommendation to have a responsible person. One person should really be in charge of inventory as a whole. You may have count teams, may have a backup person, but the goal is we've got to have one person that's in charge of this, so that we know it's that person's responsibility. They're going to be, again, responsible for all aspects of the inventory management protocols. And, running through all of our SOPs are, if you have a route accounting system, you have a route accounting system, VIP, Encompass, whatnot, they're going to have their own specific detailed procedures. So what we could do is link those in to this document, summarize them and write them in, but somehow by reference kind of bring them in here to our master document. So I'm not going to read all the bullet points because you'll kind of get the idea, but what I'm going to go through is each of those 6 items that comprise our inventory management SOP. So the first is receiving, and just some basic steps. Again, the idea is to kind of write down what you're doing, keep it as simple as possible, focus on the major process items that just have to happen for, receiving to work well. So these are just the basic ones. So when we're receiving inventory, and a lot of this is very standard, and we're doing these things anyway, but we got to do them consistently, repeatedly. They just have to happen all the time. As soon as we miss a step, inventory can get, we can have variances. So upon receipt, we want to compare the bill of lading to the purchase order. What did we actually order? what is actually being sent according to the paperwork and the bill of lading. Note any variances there. We want to count the physical items, compare them to the bill of lading, and note any variances, because obviously there can be discrepancies between all of these things. The physical stuff that arrives, the bill of lading that says what's on the truck but it isn't, the purchase order, well, this is different than. So we really want to make sure we're notating all of these changes. Again, otherwise our system inventory is going to get off. We want to inspect for any damaged goods. At the time of receipt, communicate any disputes to the carrier at the time of shipment or immediately thereafter if there's an issue. Then input that receipt into the software. Ideally, we're going to have a separate area for receiving. Most wholesalers do, or at least a section of the warehouse, so that we can ensure the product is segregated and safeguarded until it's properly accounted for and then put away and recorded in the system. So that's receiving, very basic. Again, you can add, subtract to that as it makes sense for your business. Next is shipping. So on the inventory management side, obviously we want to know we've got a pick list, we've got customer orders, we've got specific process in our route accounting system. We want to know who's picking what for a variety of reasons. Mispicks do happen. So we just want to make sure we have a good paper trail, audit trail of who's doing the picking, what may have been mispicked. If we can see these consistent mispicks happening, gives us a chance to kind of identify the root cause of that. Truck return, we've got trucks going out every day and coming back, and they'll have refusals and breakage and pickup and returns and kegs coming back. So important to think about having a second individual count the truck upon return. Open up the back, check out the paperwork, or obviously everything's now on an iPad or iPhone. What are you supposed to have on the truck as far as refusals, breakage, and so forth? Does that agree to the physical count? So we're doing a mini inventory. So comparing the physical count to the driver data. Again, a segregated or separate area for return to the product is helpful. Written process for inspection of timing to return. So once everything checks out, we're going to put that inventory in a specific place. What's the time to just check, make sure it's good, and then put it back in inventory. And then again, we want to loop in our route accounting procedures as necessary. Here, inventory counts, a huge area. As we spend so much time counting inventory, the real takeaway here is, we want to have, again, one person in charge, a good team that's trained to do this, control the count environment, and then once we do the count, making sure we have time to understand what the variances are and do some root cause analysis. What's going on that's causing variances of a certain size. Keg tracking, keg management. I'm really talking about dunnage here. So anything that you pay for that you may get money back for, deposits, right? Think pallets and whatnot. So really the takeaway here is counting kegs, pallets, dunnage, treating these like inventory, reconciling these counts with what we're supposed to have. Suppliers are sending us kegs, for example. They've likely got their own list of what they've sent, what you've sent back. So we need to do a reconciliation on a regular basis with suppliers, CHEP, the Blue Pallet Company, or whoever you use, MicroStar, or whomever you're involved with there. But making sure we treat kegs, dunnage like inventory. Cost review. Really the idea is how frequently are we actually looking at all the costs in our system. Define what a reasonable frequency is for that. Quarterly, I think, makes sense. Twice a year maybe. Your system is updating automatically, so this should all be accurate, but we really want to just cross-check that, review for completeness and accuracy of costs, look to the supplier invoices and freight invoices for this purpose. And I do think a sample basis is fine. If you're sitting on 2,000 SKUs, it doesn't make sense to look at them all. But I think if you 80-20 that process, you may find, hey, these 150 SKUs will give us 70% of the inventory or the sales out there. Let's just focus on that sample size. So that's it in a nutshell, an overview of the financial process for inventory management: receiving and shipping, return to warehouse, inventory counts, keg tracking, cost review. Again, all in service of making sure your inventory is complete, accurate, and safeguarded.